Hey there, this is Tyler Webb, the Bowtie Loan Guy down here in Temecula, California. Thank you so much for joining and watching this. Today, we are going to break down this brand new program from CalHFA, the California Dream for All program. We are super excited about this one. It comes out on Monday, March 27th. So let's jump on in. First off, just a little bit about us and our team. With American Pacific Mortgage here, who has been named CalHFA's top lender for the last few years. We are still waiting on 2022's results to come in. Fingers crossed that we can put that to 4 years in a row. We are with the Temecula branch of American Pacific Mortgage, and myself and my loan officer combined have about 45 years in the industry, a little over 45 years in the industry. And we absolutely love what we do. I especially love helping people purchase a home, especially those that tell me throughout the process that never thought that they would actually own a home. And I'm actually the down payment assistance specialist for our office. So I handle most of these CalHFA loans when they come through. And we have an extensive knowledge and a very knowledgeable team of all of the programs that we have available, including some of the other programs that CalHFA does offer. But of course, today we're going to focus on this brand new program that we are super, super excited about. A little bit about CalHFA. If you're not familiar with who they are, that is the California Housing Finance Agency. They were established in 1975, and they were designed to create affordable and sustainable housing options, which is especially needed in a higher cost area like California. Now, all of CalHFA's loans are great programs, and they have some awesome tools to help people purchase homes. And today we are going to jump into this new Dream for All appreciation share program. So we've heard rumors about this program starting in the middle of 2022. And earlier this month, they announced that it would be rolling out later this month. And so you may have heard and seen some things about this program, and hopefully this will help clear this up. But if you have any additional questions, feel free to reach on out. I'm more than happy to answer some questions about your particular scenario. So the way that this program works, the California Dream for All Shared Appreciation Loan Program, is you have the ability, eligible buyers have the ability to access up to 20% towards their down payment or closing costs as assistance funds. This is a no interest loan from CalHFA that is going to help you purchase that first home. And we'll get into what a first time home buyer truly is here in just a little bit. And this is based on the purchase price or the appraised value, whichever is lower. Now, the assistance funds, as I mentioned, can be used for your down payment, or some can be applied towards your closing costs as well. You can mix them. You can apply it just towards your down payment. It really depends on what your goal is. If your goal is the lowest monthly payment absolutely possible, you probably want to put the full 20% towards your down payment, and you pay the closing costs out of pocket. Now, if you're looking for the absolute lowest out of pocket cost, that's where you're going to maybe change it up, put maybe 17% of it towards your down payment, and then 3% towards those closing costs, resulting in that full 20%. Now, you do not have to take that full amount, and we'll get into that in a little bit, but the amount that you take is due back to CalHFA when you trigger that loan. And this is a one-to-one equity share program on the appreciation of your property. So let's say you purchase and you use 20% assistance from CalHFA. When you go to sell, refinance, or the loan comes to maturity, again, we'll go into that in a little bit here, then you would give them 20% of your appreciation. But let's say you don't need that full amount. You just want to take 10% of assistance. You would owe them 10% of your appreciation when that time comes. Now, borrowers who are classified as, lower income, which is considered under 80% area median income, which depends on the area that you're in. For Riverside County, it's around 69,000. So if you make under that amount, then you may have access to 20% assistance, but you would only give back 15% of your appreciation later on. So some more specifics about this program. This is different from some of the other CalHFA programs in a lot of ways. And one of the things is that this assistance is not forgiven. There are some other programs where after a certain amount of time, that loan is completely forgiven. That is not how this program works. You repay them, again, the amount that you borrowed plus however much appreciation you owe them at that point when you refinance, when you sell the property, or when the loan comes to maturity. And in this case, if it's a 30-year loan, after that 30-year mark. Now, we are hearing rumors that there is a one-time exception that they're going to make to refinance to a lower interest rate without having to pay back the assistance. This would be huge because right now rates are relatively high. We are projecting within the next 12 to 18 months that rates will be considerably lower. So hopefully you'd be able to drop that rate down after purchasing without having to pay back the assistance at that point. Now, anything I want to note in here, anything that has an asterisk in it is something that we've heard or something that we're kind of being led to believe is going to be a part of the program. However, since the guidelines are not out just yet, I'm not going to say it's for sure because until we see it down on paper, I can't confirm that. So if the property has not appreciated at the time that repayment is triggered, however, only the amount that you have borrowed is going to be owed back. So let's say you buy something that doesn't appreciate as quickly as you might think. Sometimes condos and townhouses tend to be this way where they don't appreciate as quickly and maybe you lost some value. What would happen if you were to sell that home or that repayment is triggered? You would just give them the 10% or the 20%, however much you borrowed from CalHFA for that down payment. Now, this has to be for your home that you're going to occupy for the next 12 months. This is designed again for affordable and sustainable housing for first-time home buyers. But this can be used for single-family residences, condos, townhouses, and eligible manufactured homes. Eligible is a very important word here because number one, it has to be on a permanent foundation, and there can be restrictions on the size of the manufactured home as well. Now, the loan limits are based on the applicable county's conforming loan limit. In most areas, the loan limit's $726,200. However, in counties like San Diego, Orange County, and Los Angeles County, you see much higher loan limits. They have what's called they're a high cost area. They have what's called high balance loan limits. For example, if you are looking in Los Angeles County, that loan limit's up to $1,089,000, just over that mark. So that loan limit will follow whatever that county allows for. Now let's break down a quick comparison of what we would be seeing here between a regular conventional loan with a minimum amount down versus this California Dream for All program. So in this first example, we're going to use a $600,000 purchase price. I realize if you're watching this in a different area that's either higher or lower, these numbers may not apply. But again, feel free to reach out and I can work out some numbers with you and show you how that would work for you. But with a $600,000 home, minimum requirement of 3% down, that's $18,000. Now we're going to add in the typical closing costs. These vary a lot from property to property. And depending on what costs are being charged by the different companies in the transaction, that can vary pretty greatly here. So we like to say it's about 2 to 3% of the sales price in closing costs. So in this example, your total cash to close, cash out of pocket would be between $30,000 to $36,000. Now, if we look at this and we compare it to the California Dream for All program, and you take that full 20% assistance, same $600,000 home, we take that 20%, as I mentioned. Now, the assistance, of course, can be divvied up in different ways. So it kind of depends on how you apply it as to how your cash to close is calculated. But there are ways that you can set this up where your cash to close is next to nothing or absolutely zero, up to $18,000. So if you have questions on how that works for you, let me know. We can show you how that works. But this is obviously an awesome opportunity for someone who maybe that barrier to entry was that down payment amount. You can get in for next to nothing, if not nothing. So I want to break down how the shared appreciation works. So looking at a $500,000 home in this example, they give you that 20%, which is $100,000. And let's say in 5 years, it appreciates up to $640,000 and you want to sell at this point. Well, that $140,000 that it appreciated, CalHFA is going to take 20% of that appreciation, so $28,000 here, plus the original contribution, so $100,000. So you are going to give them back $128,000. And on top of that, you will get the equity remaining. So in this example, now you have equity of $142,000 because you have the amount that you first put in, and you have the appreciation, that the remaining 80% appreciation that you get to keep. And we also have this chart that breaks down how this would work over time and how it would be paid back to the Dream Fund for All program. So as you can see, as you go through time here, you build that equity, the amount of equity you will gain is going to increase exponentially, whereas the amount that CalHFA is going to get back remains the same because it's going to be that 10, 15, 20%, whatever you take from them. So this is a really exciting program for people who are looking for that long-term investment. Of course, your primary home should not be a short-term investment. This is something that you want to sit and be there for a while, not something that you're hoping to just flip in a year or two and sell for a quick profit here. Now, some more specific requirements about this program, again, that we are hearing about, that we are expecting could be in the guidelines for this program. Number one is that the minimum credit score would be 660 if you are under the 80% area median income. And if you are over that amount, then you have to have a 680. This is a conventional program only. If you're looking for an FHA type loan, there are down payment assistance programs that would go with an FHA program. This one is going to be strictly conventional, and we're expecting the max debt to income ratio will be about 45%. Debt to income is calculated looking at your total gross income, subtracting out any monthly debts that you have, and we're looking mostly at car payments, car leases, credit card payments that aren't paid off in full each month, other installment debts like personal loans or student loans, even if they're in deferment. All of those things are factored into your debt to income ratio. We're expecting, again, it'll be about 45% of that total gross monthly income will be that allowance amount. And then, as I mentioned, there's going to be income limits that depend on the county that you're in. And in here, I included as well what the 80% area median income amount would be. So in Riverside, San Bernardino counties, we have the same amounts. It's $173,000 for the year. So as long as you make under $173,000 for the year, you should be eligible for this program. Again, confirm that when the guides come out. But if you make under $69,920 a year, you have access to a little bit more favorable terms here. The FICO score, you can be a little bit lower. The rates could be a little bit lower. That's one thing that CalHFA does, is if you're under that 80% area median income, they typically give more favorable rates, at least for their other programs. So we may see that with this as well. If you're in San Diego County, you can make up to $211,000 a year. If you're in Los Angeles County, that number is $180,000 per year. And if you're in Orange County, that number is $235,000 for the year. And then you see those AMI amounts there. San Diego, just over $85,000 for the year. Los Angeles, just over $78,000 for the year. And same for Orange County. Now, again, you must be a first-time homebuyer for this program. And this is defined as someone who has not owned a home in the last 3 years. So even if you've bought a home before, it's been a little bit, over 3 years since you owned a home, you are eligible for this program. So it, again, can be an awesome game changer for someone who the barrier to entry for them to purchase has been that down payment amount. So if you have any questions, please feel free to reach out to me. You can comment here, but the easiest and best way would be to either call, text, or email me. Have my contact information right here. Hopefully you found this really helpful, and stay tuned for our future videos and events. Thank you so much.